A major question investors are asking: are the U.S. tariffs truly achieving economic goals, or are they merely tools in a larger conflict? Data and political economy theory reveal a complex picture of three-layered dynamics, and the third layer, what will define market trajectories for the next decade. In this video, we'll walk through a structured three-layer analysis. First, U.S. domestic political economic drivers. Second, objectives to rebalance trade and tech. And third, most crucially, the restructuring of the global trading system. Finally, I'll provide a clear framework for you to assess risks and opportunities in your own portfolio. The first layer of analysis must be U.S. domestic political economy. Tariffs are often justified by the infant industry theory. But here, the protection targets once powerful, now declining industries like steel and traditional auto manufacturing in politically pivotal swing states. Research from the U.S. Congressional Budget Office indicates the costs of tariffs fall primarily on U.S. consumers and businesses. However, political pressure from voters who lost manufacturing jobs is real. Therefore, this move must be understood as a domestic policy tool, catering to a specific voter base and fulfilling campaign promises, despite potentially negative economic efficiency. The second analytical layer is structural objectives. This isn't just about shrinking a trade deficit figure. The U.S. aims to alter the foundational conditions of trade with China. These are reducing strategic dependency on a single source, a risk exposed during the pandemic, pressuring China to abandon policies like forced technology transfer and state subsidies, and slowing the progress of Made in China 2025 in high-tech sectors. This is evident in targeted sanctions on companies like Huawei and SMIC. This reflects strategic realism in economics. National security trumps market efficiency. The consequence is a fracturing of global technology value chains, leading toward parallel tech ecosystems. The deepest and most crucial layer for investors is the paradigm shift. The trade war is a catalyst, accelerating a pre-existing trend since the 2008 crisis, the shift from a model of globalization for maximum efficiency to one of regionalization for optimal resilience. Companies now prioritize supply chain security over lowest cost. Foreign direct investment flows are shifting markedly to regions like ASEAN and Mexico. Inflation now has a structural component from this reorganization cost. For financial markets, this creates new performance divergence. Markets like Vietnam, India, and Mexico benefit from production shifts, while companies entirely reliant on the U.S.-China export model face heightened systemic risk. So, to summarize, we have a three-layer framework: domestic politics, tech strategic competition, and trading system restructuring. As an investor, you can apply this framework with three questions. Is this company or asset within the sphere of U.S. domestic political pressures? Does it depend on technology value chains that are fracturing? Is its business model based on efficient globalization? Or does it have resilience via regionalized networks? Answering these will give you a much clearer risk picture. Economic history shows that major turning points come not from short-term frenzies, but from deep structural changes. This tariff war is a signal of precisely such a structural shift. Our task is to analyze, understand, and reposition our portfolios accordingly. Thank you for watching. I'll see you in the next one.